Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. Hi, everyone, and welcome. I'm thrilled to have you join us for today's LinkedIn Live event. Whether you're tuning in live or catching the replay, thanks for being here. This will be republished as an episode of our Create More Value podcast. And if you're tuning in there, we recommend you view the YouTube version since we will be using some slides. We will be sharing with you the basic structure of what we firmly believe is the world's best incentive compensation design. My name is Greg Milano, CEO of Fortuna Advisors, and I am joined by my business partner, Marwan Karame. As a quick introduction, Fortuna helps companies achieve top quartile value creation by rethinking how to strategically allocate resources and embrace value-based business management. Over the years, we've worked closely with CEOs and CFOs, and we have found that it is really important, if you want to walk the walk rather than just talk the talk, to tie incentives to value-based measures. In the next 45 minutes, we'll walk you through the difference between what companies typically experience versus the 5 key traits of a value-based ownership culture. We'll explain the shortfalls of a typical incentive plan and the major improvements we embed in our owner-like incentive designs. The basic structure of our incentives will be explained, which of course gets adapted to the unique company situations. We'll talk about 4 important simulations to illustrate how better behavior is motivated by our value-based incentive design. If you're watching this live, please submit questions and we will try to answer them before we finish. Let's get started. So companies that embrace economic profit outperform on TSR. In other words, this framework actually works. And the way we know that is that we published this study of our research a few years back showing that all of the companies that show in their proxy statement some form of economic profit in either their short-term or long-term incentives or both, on average, outperform on annualized total shareholder return. They outperform the market by 7% a year, and they outperform their peer companies by 5% a year. And bear in mind that some of these companies have been using, a framework like this, for, over 20 years. And so, if you compound, 7% a year for a long period of time, it's a tremendous amount, billions of dollars, of value creation. So the system works. And when we talk about value creation, we think about change management, and there are sort of 4 steps to change management in terms of questions we should ask and critical actions we should take. The first is, why do we have to change? That's the question people frequently ask. And, we want to establish an objective fact base that makes the case for change so that people understand, this is something that's going to be better for the company and it's going to be better for me. Second, they wonder, what does the future look like? And we showed them how strategically mapping the allocation of resources and diverting capital, innovation money, and marketing money toward the business units or regions or markets or customers or products that creates more value is going to lead us to be a more successful company. It's work inside the company that mimics what what Warren Buffett does, right? He picks stocks that go up and doesn't pick stocks that go down. We want to be picking the parts of the business that create the most value and really concentrating resources in those areas. Next, they wonder, what's my part? And so it's important to implement communications and training to show them what they can do to embrace value-based management. And we need to support that with changes to management and business processes, some tools, and so forth. And in our next LinkedIn Live, we're going to actually be talking about communications and training of these things in specific. So we'll get to that. And lastly, and very relevant for today, what's in it for me? And we want to show how we can design an incentive plan that makes what's good for the company and the investors also good for employees and their families. Now, we want to talk about sort of the contrast between what we typically see inside of companies in terms of behavior and what we call the sort of ownership traits, the 5 key traits of an ownership culture. And first up, we have inside most companies, there's a spend it or lose it kind of mindset. Whether it's an expense budget or a capital budget, people feel that if they don't spend the money, it's going to be taken away from them at the end of the year. And if they underspend their budget, they may not get a big enough budget next year. So they're very concerned about that. And so the sort of use it or lose it kind of mindset prevails. But an owner would never behave that way. If a person could save some money at the end of the year because maybe they didn't have enough good things to spend the money on, they would view that as a good thing. They wouldn't be afraid to spend money if there were good things to spend on, but they also wouldn't be afraid to not spend money. So we want people to spend money like it's their own. Next up, in most companies, the leadership hedges their bets by smearing resources around the organization, giving everybody a little bit. They're not so sure exactly who's going to be successful, and they don't want to make the mistake of underinvesting in an area that turns out to be successful. So they give everybody a little bit of money. In an ownership culture, we spend a lot of time trying to figure out where do we really create the most value, where do we get the most bang for the buck, and concentrating resources. And that's what our previous LinkedIn Live episode was about strategic resource allocation. The next one is risk avoidance, which it sounds like a good thing, but if it's taken to an extreme, people even avoid good risks where the risk reward trade off is positive, but they're afraid of taking any downside risk at all. If you only do things that you're 100% certain are going to work, you're not going to be innovative enough to keep up with the competition, and you're going to lose your competitive advantages. You need innovation to maintain and strengthen your competitive advantages, and in order to have that, you need to experiment. You need to try some things that you're not 100% sure are going to work out. And we call that a willingness to fail, a willingness to experiment and sometimes fail. Next up is analysis paralysis, which it seems pretty much every company that we work with experiences, albeit to somewhat varying degrees. And it's the indecisiveness that comes from people being afraid of making a mistake. And meetings often end with a list of things they need to study further and another meeting date in 2 weeks. And this can go on, ad nauseum, and no decision ever gets made. In an ownership culture, there's much more doing and less talking. People certainly consider all the facts they need to be able to make a decision, but they're not afraid to make a decision, and they move past the analysis phase into the implementation phase of decisions much faster because they're not so afraid of doing something wrong. They're exposed to upsides and downsides, and they're not so afraid of doing something wrong. And then lastly, in most companies, there's a sort of variances to plan and guidance mindset, which is at odds with the idea of continuous improvement, right? When you measure people against their plan, and we're going to talk about this quite a bit on the next few pages, you're basically paying them to plan for mediocrity because they want to get a very achievable plan. And so they're not going to stretch. They're not going to try anything tough. And the same applies in terms of external guidance for companies that give guidance to public companies that give guidance to investors. But we know that it's about the long term and the short term. That's an important ownership trait. And because of that, what we want people that want to drive performance as hard as possible and at the same time be very willing to make big investments in the future. That's what entrepreneurs do, and that's what people inside a true ownership culture do.
Yeah, I think
Take it.
in traditional, a lot of the traditional incentive plans, sometimes it's tough to kind of think about the long and the short term because a lot of times people don't know what's their part in trying to drive value. So many of the rewards are based off of overall company revenue or volume or company margins and EBITDA. And that only takes into account some of the things that can be done within an organization to drive value. In fact, there's so many people within the organizations that impact the company beyond just revenue and margins, everything on the P&L. There's, achieving improved payment terms. So, somebody in accounts receivable or being mindful of capital spending levels in operations, or at the strategic level, thinking about smart investments, generating future value and putting more to work at a profitable return. And then also the opposite of that is making sure you stop projects that aren't generating value, which may not be seen in the P&L, but could definitely be seen on the balance sheet of a company. And then, of course, investing in safety measures to reduce risk. Where does that show up? Often in terms of what your risk profile is and the cost of capital. With an owner-like incentive, you want to be able to acknowledge and reward people for all the value that they create, not just some of the value create. And that's effectively the incentive plan that we always try to achieve, is this owner-like incentive plan that considers all value creation within an organization and really aligns the managers and the employees to think like owners and be aligned with the investors. For traditional incentive plans, that often falls in contradiction to some of the things that an owner-like incentive plan really tries to achieve. Some of the things that we found that are shortfalls within traditional incentive plans, if you look at the chart on the left, the vertical axis is your bonus. The horizontal axis is the performance level and the targets to achieve a certain level of bonus. For a lot of organizations, the first problem is they have the wrong performance measure. It has too many, they have either the wrong measure or too many conflicting measures. They might have three measures where two go up, one goes down, or one goes up, two goes down. Which one do you want to really focus on? What's the arbiter on whether you're actually doing a good job or a bad job in terms of company performance and value creation? The second is these threshold and caps that end up resulting in year-end sandbagging. If you're not going to meet your threshold, the game is let's miss it by a lot, just as long as we don't get fired, and that way we can renegotiate a target for next year that's much lower. And then on the other side of the equation, when you hit your cap, there's really no incentive to kind of push the envelope and sprint even further beyond that level, because you're just going to make things harder for yourself the next year when you have to set targets. And you much prefer having some of that performance fall into the following year where you can get a head start. So this creates a lot of dysfunctionality. Also, the targets themselves are often independent of creating shareholder value. There's no shop floor line of sight to how value is created and how you drive total shareholder returns. That then results in the fact that these targets are really based off of budget negotiations. And when you set targets based on budget negotiations, it's basically a formula for mediocrity, because that's what it incentivizes. And then lastly, each year is independent of the others, leading to short-term thinking, because you've just got these 1 year sprints and then everything resets. What we've really tried to design and develop is an owner-like incentive plan that, number one, connects performance to actual value creation. So we use residual cash earnings, and I would encourage those who haven't seen our previous LinkedIn Live events to take a look at what residual cash earnings is. It's basically a cash-based economic profit measure of performance that really closely ties to total shareholder returns. And so the first thing we do is we set targets based off of prior year RCE, residual cash earnings, such that when things go up, that's good. And when things go down, that's bad. If it's going up, it means you're creating value. And if it's going down, it means you could do better investing your capital in things that will generate higher return. The second major issue is the caps. They're often, in many cases, too low, but we try to set them a little higher, up to a 200% minimum, or maybe even 250, 300, depending on, the culture of the company. Any performance beyond the caps, which is really, I would say, sets this incentive system apart from anything out there, is that above cap performance rolls into the next year in the form of a lower target. So effectively, there's not these short-term sprints. 1 year can lead into the next in terms of giving you an advantage or a disadvantage. And that plays a big part in managing both for the long and the short term. The second is we like straight lines. So the linear payout curve goes down to zero with no threshold. So every dollar is worth the same. There are no kinks in the line, because we figure a dollar is a dollar and it should be paid accordingly in terms of a commensurate bonus percentage. And then lastly, you can't just have an option on the upside. The same falls true that there is no benefit from underperforming to drag targets down to the next year. In fact, a performance below the threshold actually rolls into the next year in the form of a higher target. So now what you're doing is aligning both the short and the long term in a way it simulates an ownership within the company. The basis of our incentive plan is actually really simple. Foundationally, it's really simple. First of all, you're not having a basket of measures to focus on. You're focusing on one superior single measure of performance that pretty much embodies all the other metrics that you would face, financial metrics that you face, and in many respects, quantifies the qualitative drivers of value creation. And so residual cash earnings is the basis of how you perform. It's the improvement in RCE that we're looking for. And because of that, the target can simply be set to last year's performance. So if EBITDA rises enough for gross cash earnings, which is basically EBITDA on an after-tax basis, to exceed the capital charge, then we know value is being created and you've achieved a return higher than what was expected by shareholders. So commensurately, you should get a higher bonus. Lastly, we then calibrate the payoff curve such that it takes into account the volatility of the residual cash earnings. What we don't want, which you'll see in a lot of traditional incentive plans, is there's this cup formation of payouts. So, budgets are set, targets are missed, you get a zero bonus payout. And then the next year, targets are set lower to try to, make up for the previous year. They're set so low that you get a 200% bonus payout. And you're either getting 0 or 200 in a lot of organizations that we've seen. What you want is a bell curve payout. And that is something that you can do very simply through quantitative analysis to make it very fact-based. The biggest attribute, I would say, this incentive system is that unlike traditional incentives, you're not basing targets on budgets. So you'll see that in a lot of organizations, managers, might be trying to, shoot for the stars. They're shooting for greatness. And so they'll set their plan based off of a very frothy expectation of performance, then realizing that plan is now their incentive target. So then moving forward, they do perform extremely well, but they get paid nothing simply because they missed expectations. So the manager learns pretty quickly that it actually pays to plan for mediocrity and perhaps even some deterioration in performance. And if they can set expectations low enough, even if they don't improve, they still will get rewarded for it. And this cycle can be perpetuated on and on. What we do is basically say, look, your 100% payout if you meet last year's performance. So anything above will give you a payout greater than 100%. And then the following year, it gets reset from where you left off. And if at that point you've done really well and now you're looking for better growth opportunities, you decide to make an investment and perhaps in the short term may fall short and get something less than 100%, you can make it in the following year and do quite a bit better, substantially better going forward. And this is basically the basis of our incentive plan, driving tremendous amounts of value for the company and having everybody participate in it. Now, one of the biggest questions that often comes up is, wait a minute, so you're saying I just have to hit last year, so I don't have to grow the business. And that, in fact, is not the case. So we'll give you an actual numerical example of this or illustration. Let's just assume last year you invested or have gross operating assets invested in the company of about $3,000. Your required return is 10%. You now have a capital charge of $300. That capital charge basically represents the profit you need to generate to meet shareholders' expectations of 10%. And if you can do something above it, you've created more value. If you've done something less, then you haven't created as much value as the investors could elsewhere. So this is last year. Now, next year, you end up investing $300 of CapEx, R&D, working capital to increase your GOA to $3,300 this year. The capital charge now has increased to $30. So now your capital charge goes from $300 to $330 because of the incremental investment made. Well, in order to achieve last year's RCE, what we need to do is generate a gross cash earnings that meets the incremental capital charge. So EBITDA and GCE must rise enough to cover the capital charge on the incremental investment in the CapEx and R&D. and working capital. And as a result, despite RCE being the same as last year, you've actually grown gross cash earnings. Assuming, let's say, that you have GCE margin of 20%. So that's your GCE divided by your revenue. And that you expect to maintain the following year or this year, and as well as with the incremental GCE that you've created, then that would mean that your revenue would have grown $150. That's the 20% divided into 30 of GCE, $150, which is a 3% growth rate. So just maintaining your RCE from last year doesn't mean you're not growing, but you're growing to meet the capital charge and the required return by shareholders. And that's extremely important. The impact that it has within organizations can't be understated. In fact, it reminds me of experience during the COVID pandemic. And I happened to be catching up with the CFO of Varian at the time, Mike. And I don't know, as we all remember, it was a pretty difficult time. The markets were rattled. The supply chains were in disarray. It would have been completely understandable for executives to look for some flexibility in their compensation plans. So I asked Mike, kind of offhanded, if they were thinking of going to the comp committee to see if they could get some relief. And I mean, after all, it was a black swan event, right? In any case, Mike's response actually caught me totally off guard. He was offended, but in a good way. He's not angry, but firm. And he said, "Why would we even consider that?" And the last thing he wanted was to go back to the 8 months of negotiating a plan just to establish targets when you could do that in an objective way. And when you do it objectively, now people start shooting for the stars. And if they hit the moon, that's a good thing. Even though they may have missed expectation, doesn't matter. They just need to continue to improve. And so he, instead was laser focused on how they could sprint through the finish line for the year, how they were going to mitigate risks, and really come out stronger on the other side to crush it. Which, by the way, they did. I mean, he knew, like any new owner would, was that while there might be some sort of short-term hit to compensation, if they made the right moves, made the right decisions, over the long term, it would pay off more than it would cost them in the short term. And he was definitely right. They did extremely well coming out of COVID. And that conversation struck with me because it was just about getting paid. It wasn't just about getting paid. It was about accepting full accountability and responsibility, not making excuses regardless of the situation. And if there's ever time to make an excuse, it was then. And that's what it looks like when you act and get paid like an owner. And quite frankly, I think your book, some of the simulations in your book do a really good job, Greg, of demonstrating some of the behaviors that are created when you have this incentive plan. And I don't know, it's worth noting and just kind of talking a little bit about that.
Actually, if you just go back to the prior page for 1 second, there's one other situation I wanted to relay because I think it's an important thing that might not be appreciated by the viewers. So our RCE, residual cash earnings measure, is based on gross cash earnings. We don't charge depreciation, and gross operating assets. We add back the accumulated depreciation. And we originally did that when we founded our company 16 years ago because it helped us to correlate better with share prices relative to EVA and other traditional forms of economic profit, which use net profit and net assets in the capital base. And I just wanted to point out here, it winds up having a really good positive impact on the way this incentive plan works. And the situation was a client of mine that had an activist investor on the board. And before the final approval of the incentive plan happened, he and I had a discussion. And he wasn't aware of the specifics of how depreciation is treated in this measure before the conversation started. And so he was saying, if you set targets equal to last year, you're just giving people a windfall. Because what he was thinking was the depreciation brings down the asset base, and the capital charge gets smaller every year. In that case, this investment might just offset depreciation, and the capital charge would stay the same. And so there would be no need to improve gross cash earnings, no need to grow, like Marwan was explaining, in the future. And when we finally sort of worked through the numbers and he appreciated the fact that, the assets don't depreciate, they just stay there. And so when you make new investments, the asset base goes up, it doesn't have that depreciation effect. He bought off on it and signed off on it. So, it's a really important distinction here that because we don't depreciate the assets, we can set targets equal to last year. When Marwan and I were at Stern Stewart, the EVA company years ago, we always had to calibrate an expected improvement in EVA to offset the effect of that depreciation. We don't need to do that anymore. And every incentive plan that we've designed works this way, where the RCE target is last year's actual. That's the point at which you've earned an adequate return on your incremental investments, during the year. So thanks for giving me a minute on that, Marwan. So if we go to the next page, in my book, there's an entire chapter on incentives, which covers some of what we covered today, but also a lot of other things. So I encourage anybody who's serious about this to refer to that. And in this particular chapter, after explaining the mechanisms and so forth, I put in 4 little quick sort of simulations to sort of illustrate how the behavior motivation is really different from what happens with traditional incentives. So, Marwan, if you go to the next page, I'm going to start with a baseline here. And so RCE, which again is residual cash earnings, starts out at 100 million, let's say, and it grows by 5 million a year. The delta RCE is the change in RCE. That's line B. And so over the 5 years of this experience, there's a total of 25 million of improvement in the baseline case. And so now if we look at the next line is what we call the bonus sensitivity. That's the amount by which my RCE has to increase to double my bonus or decrease to go down to 0 bonus. Again, it's a straight line, as Marwan explained a few minutes ago. And so we've got this bonus sensitivity of 20. And so now when we do the bonus calculation, the performance multiple is line B divided by C, the 5 divided by the 20, or 0.25 in every year, because it's nice, steady, straight line improvement. I mean, obviously, in the real world, nobody has exactly 5 million of improvement every year, but this is a good base case to compare to the next few cases. The target multiple that you get for just achieving last year is your target bonus, or 1x. And so when you add them together, the overall incentive is 1.25x. And if this person had a $100,000 target bonus, we would calculate their total incentive at $125,000 each year. And over the 5 years, they would make a total of $625,000. So I want you to remember that $625,000. It's really important as we go through the next examples. The first thing we're going to do is we're going to look at a situation where there's a temporary problem that reverses the following year. Perhaps this is a raw material is in shortage, and so the price spikes, and it has a big negative impact on our profit. But the problem that caused it is a temporary problem, and we think, by next year everything's going to be back to normal. So in this case, our RCE goes down in year 1, but the problem goes away completely in year 2. So we get back to the original plan. Year 2, year 3, year 4, year 5, 110, 115, 120, 125 are exactly the same as the baseline. So we had a one-time hiccup that then bounces back. And you can see the total improvement is 25, just like in the base case. The bonus sensitivity is still 20. So what happens is we lose half our bonus in year 1, but we get all that back in year 2. We're in total, we're down 0.75 versus the baseline in year 1, and we get back that 0.75 in year 2. And when we look at the dollars that the person actually receives, and here we added another line to show the increment, what happens is they lose $75,000 in year 1, but as long as it really is temporary, they get it all back the following year. And so, if you've got this kind of a problem, you're going to do things to try and deal with it. Obviously, it's a problem. But if you believe in your heart that it's a temporary problem that's going to go away the next year, you're not going to focus on that anywhere near as much as a permanent problem, which is what we're going to get to on the next page. So temporary problems, you lose money, but you get it all back the next year because it's always based on improvement. Now, when we talk about the same decline in the first year, the minus 10, but now it's a permanent decline. So we go back to improving by 5, but we don't get back on the original track. The total delta RCE in the right-hand column is 10. On the prior 2 pages, it was always 25. So we're losing long-term value here, not just short-term value. It's a one-time decline that's permanent. Now, the way this can happen is a competitor launches a superior product in one of our markets, and we lose market share, and that's permanent market share. And in this case, we're going to assume, we do nothing about it. And now in this bonus sensitivity is the same. We now get performance multiples, again, exactly the same as the prior case, down in the first year, but we don't get that back. We just get back to the baseline in year 2. If you remember, when it was a temporary decline, we went all the way up to 2x in year 2. So we got back to 0.75 that we lost in year one. And you can see if we carry it through to the dollars, we lose the $75,000 and we never get it back. The total payouts for the period went from 625 down to 550. So now if you're faced with two problems in different parts of the organization, one's a temporary problem because of a supply chain issue that you think is going to reverse by next year, and the other is a permanent problem because somebody launched a better product than yours. That's a permanent loss in sort of market share. You're going to devote the vast majority of your attention to trying to fix the long-term problem, not the one that's a short-term problem. Now, if you're in an annual bonus plan that's measuring against budget, in all these cases, you're going to get whacked in the first year. And in all these cases, the expectation for the next year is going to get baked into next year's budget. And so you're never going to get paid back in the recovery case. And you're basically in year two, you're going to get treated exactly the same in all these different cases. So you're going to focus the same amount of attention on the permanent problem as you are on the short-term problem. But we can see from sort of basic valuation of these businesses, it's much more important that you focus on the permanent problem. So this idea of measuring against last year gets us thinking a lot more about, is this something that's a long-term problem for the business that's going to have a huge detraction to value, or is this a short-term hiccup that's going to go away next year and encourages more owner-like behavior? The best case, though, is the last one. Now, let me go through this one slowly because it's a little different from the other ones. Here, once again, we lose $10 million in the first year. But now the improvements in year 2, 3, 4, and 5 are much bigger than before. And this is because we've made an investment that weighs on the performance in year one. And then in all the other years, we have a big upside. You can see the total improvement is 45. The highest we had in any of the previous cases was 25. So it's almost double the improvement because this investment pays off. Now, in most companies, you'd get whacked again in that first year, but all the benefits would just get folded into the budget in the future years. So you'd never really get paid for the upside. This is one of the most important things about our incentive plan. If you create value, even if it takes time for it to materialize, you will get paid for it. In most companies, the budget negotiation takes that away. We don't do that. If you create value, you will get paid for it. And that's an important part of motivating these long-term decisions. Let's go through the math. Same bonus sensitivity. Performance multiple drops to 0.5, but then it's 185, 175, 165, 1.5. All four of those are higher than the base case. And if we carry it through to the dollars, they give up 75,000, but then they get back an extra 60, an extra 50, an extra 40, an extra 25. And when I was writing the book, I thought about this, and I actually calculated an IRR for these 5 years of bonus. So what's the IRR for the executive? And it's a 55% annualized IRR. So now they're looking at this and they're thinking about it just like any other owner would. Do I believe my forecast? Is it worth giving up money now to get money later? Do I have enough confidence? And the real world example of this that I think is it was one of my most satisfying moments in my career to see this behavioral impact. It was a client pursuing a major project that was going to have a big impact, a big percentage impact on the company, and it was going to require a lot of investment before the return started to come. And the executive team was meeting. I was with them. And the CEO looked around the table and he said, look, we're going to lose, over half our bonus in the first year if we do this. But if we're right, we're going to get, 3, 4, 5 times that back over the next 5 years if our forecast is accurate. So the real question is, do we believe our forecast enough to put our money where our mouth is? And I mean, there were like tears running down my face. It was like one of the most satisfying moments ever. But that's thinking like an owner. That's thinking exactly like an owner. And this incentive system encourages that kind of thinking better than any other incentive system with bad measures, with measuring its budget, caps and floors, and all the other problems. It motivates that kind of ownership thinking. And this is the best sort of example of how it changes behavior versus the traditional incentive plan.
Yeah. And you see it play out, it comes back to the 5 traits that we always talk about of an ownership mindset and culture, is where you spend money like it's your own, but not just, trying to cut costs, but invest, like in that last example, knowing that you're putting your money up at risk. And then, you've got to believe in the forecast. And it's also about extreme prioritization, not frivolously putting the money in things that aren't going to move the needle, but the things that really are. So, really building wealth by concentrating your investments in the things and your resources and things that are going to create value. Then followed by willingness to fail. And again, it's not just taking senseless risk, but really smart risk, experimentation, piloting things, and having gates that then earn the right to grow further and take further risks. The fourth, more doing and less talking, which you spoke a bit about, and then it's about the long and the short term, which is really what this it encourages is a little bit, quite a bit of both, meeting the short term demands, but while delivering very long term results, and that's what makes this so strong. I think for anybody interested, we actually are pretty proud of this. The Journal of Applied Corporate Finance had published basically all of the articles that we've written over the years, sort of in honor of Fortuna Advisors. And as a token of our small appreciation for joining us today, if you're at all interested in this, feel free to email us at info@fortuna-advisors.com with the subject JACF request live LinkedIn. And we'd be more than happy to send you a copy. Just put your mailing address in there. On that note, maybe we'll take some questions here, or take a look at some questions that are often asked. Well, here's one to consider. This is good. My business is very volatile. How can this work?
Yeah, let me address that first. So there are two main mechanisms, one simple and one's a little bit more complex. The simple one is, Marwan, when he showed the sort of slope of the curve, we calibrate that slope of the curve to the volatility of the business. So if it's a more volatile business, we flatten the curve out so it dampens the volatility of the bonuses. And, we use traditional statistical analysis to analyze the volatility of performance for a company and its peers to get a sense of what that slope should be. So we get about the same amount of bonus volatility in all companies. That's the standard thing we do in every incentive plan design. And sometimes we even vary that for different businesses in a company if there are big differences in volatility. And then there are some more sophisticated ways of trying to create cyclical-like mechanisms that, when you're low, tend to drag the target up, and when you're high, tend to drag the target down. And they're also empirically derived, but they're a little more complex to try to implement, which is why we tend to try to just deal with it, with the slope of the curve.
Another one here is, what do ISS and Glass Lewis think of this? These are the proxy firms.
Yeah, this is a common concern that pretty much everybody we speak to has, because they're so important these days. I guess a couple of notes. First, ISS purchased EVA Dimensions in 2018, and they have that as a department within their company. So they're very familiar with these kinds of programs. And they still evaluate, obviously, to make sure they believe in all the structural elements of it, to make sure it makes sense to them and so forth. But with the incentive plans that we've designed, we've found them to be very supportive. And Glass Lewis, although they don't have that sort of EVA tie-in, has been supportive as well. I think we've had very good response from them to the incentives. The incentives are very fair to the shareholders and to the employees. So we've tended to have pretty good support from them.
Yeah, and I think in one of our implementations, the company got the first 4 vote that they have ever had in their history deploying this. So it was well received. Mm-hmm. And that was with ISS, I believe. If I do something so different from other companies, will I lose talent?
That's a really a common concern as well, because what they often do to try and make sure they don't lose talent is they look at what everybody does and they just do the same thing. And to be honest, the standard incentive plan is so ineffective that just copying what everybody else is doing is a formula for failure, to be honest. But in our experience, we have seen people that are not very confident about the future worry about the sort of absolute accountability of our framework. They can't just negotiate easier budgets and that sort of thing. And so there has been a little bit of concern of losing people like that. But the people that have confidence in the future tend to like this better. In fact, if you're in a company where you have a lot of confidence that you're going to be creating a lot of success and improving performance in the future and creating a lot of value, you're going to get paid more using a system like this, than you will with a traditional plan, because all the benefits of that improvement won't get baked into the budgets every year. You'll actually get paid for it. And so the people that have confidence, tend to stay. And so overall attrition tends not to be significant, and it tends to be selective in a way that's not really that bad, to be honest.
Yeah, I would argue that it even attracts better talent too, because you get people who are so confident in actually creating improvement versus trying to negotiate plans and stuff like that. Really operations people that know how to execute. If anything, they'd love this stuff, or they tend to. That's been.
Yeah, we had one CEO actually tell us it was a competitive advantage in recruiting. So to your point, so yeah, that's a good point. It's not just about attrition; it's also about actually stronger attraction of people that sort of believe in themselves and believe in their ability to drive success.
Mhm. Here's another one. How deep can you take this in a company?
This, I would say, is a very company specific decision. We've had companies where this kind of a framework is only used for, you know, upper middle management and higher, or even just senior management. And we've had other companies where it's taken all the way to the shop floor. There is a trend of actual ownership, driven a lot by Peter Stavros at KKR and others, and Ownership Works and other organizations. And so the idea of getting owner-like thinking right down to the bottom of the company is a growing trend. But a lot of companies are still not ready to embrace variable pay that deep in the organization. So it's not a necessity to take it deep. It does work well for companies where it's suitable to take it deep, but it can be used in some cases for just probably the most common answer is upper middle management and higher. And even if you do take it lower, it's probably done in stages where you start with the more senior people and then roll it down over some period of time, so that when people look up and say, "What is this all about?" The people they ask have actually been using it for a bit, so they have a better familiarity. That kind of a rollout works really well.
Last one. My comp committee is old fashioned. How can we get them to buy in?
Yeah, I mean, a lot of people that are on comp committees are, retired executives, or a lot of people that are on boards are retired executives. So you do wind up with some or all of the comp committee members, being used to more traditional approaches, and they find this to be, sort of new and unfamiliar. And so it takes some time to bring them on board. Usually, we educate the full board on, what the measurement framework is about and how it's going to affect planning and decision making first, and then we have a preview with the compensation committee after that to show them the basic structure we're thinking about and to get their input of anything that they'd like us to consider or study or simulate. And then once we've actually calibrated this full system, we go in for approval. And there's usually at least 3 stages. Now, having said that, one of our clients, now we were first hired 4 months from the end of the year, and we designed the measure, designed and calibrated the incentive, brought the board and the comp committee on board, and got the system improved to go live for incentives, with the start of the new fiscal year. That was faster than you probably should do it, but it actually wound up working very well because we did a little bit of communication just so people knew what was coming before it came. The other side of it is every time we've ever done it, the comp committee has gotten on board. Every time they've gotten on board, and I don't know what I was saying. So the one time when we went really fast, when we got to the full training, the deeper training of really educating people on how this should affect their decisions and so forth, after the start of the fiscal year, they already knew the incentives had changed. And the amount of focus and intention and pre-studying and follow-up from people was stunning. And so although rushing to get incentives changed is not something a lot of companies are eager to do, it actually wound up having a very positive impact on the sort of speed of the acceptance and the diligence with which people came into it. If you start educating people and there's a possibility that down the road we might do incentives, there'll be a lot of people saying, "Oh, if it gets real, I'll worry about it then," and they're not quite as attentive, at least in some organizations. And so, doing it very fast, was an ability to, did have a positive impact. And the sort of more old-fashioned committee members, all got on board.
I just want to add to that. I think a lot of times compensation in the compensation industry, compensation consultants, at least traditionally the ones that I've seen, they are fantastic at looking at competitive pay practices. Like that's what they do. Like, what does everybody else do? But ask them, hey, what's the incentive plan that's going to drive total shareholder returns? And their answer is usually, look, you just tell us what the measures you are, and we'll tell you what everybody does, right? And I think that's the thing that I guess distinguishes us is we're trying to break that dysfunctional wheel, if you will, that creates all the shortfalls that we showed of traditional incentive plans. And so therefore, one way to think about this, the fact that it is different is a competitive advantage. And any strategic competitive advantage is one that's tough to replicate and one that sets you apart. So I would say it's a plus. The more that companies that do adopt it aren't just following the herd, it's going to pay off in ways that they could never imagine. But In any case, I think we have another question. The question was, here we go. Does the plan reward collaboration or individual performance?
Okay, thanks, Bonnie. Appreciate the question. And so the basic plan definitely promotes a lot of teamwork, a management team working to try to, like as if they were all owners, trying to drive collective ownership value higher. In companies that have multiple businesses, we'll measure RCE for the business units, and usually the payout for a manager will be like 75%. Let's say it varies, but let's say 75% based on their business and 25% on consolidated. So they have more incentive to focus on driving their own performance. But if they come up with ways to improve RCE, they have an incentive to share that with the other business units because they do participate, based on the consolidated company. And a lot of these plans will also have, RCE will be the only financial measure, but then there'll be, maybe that's 80% of the total reward, and maybe the other 20% is individual goals and that sort of thing. So we can make sure we can individualize it, especially as you get a few layers away from the top of the company. So yeah, we can find ways to design it to provide the right balance between sort of individual accountability and motivation and collaboration. One company, for example, they flipped it. They only had 25% of the reward based on the business unit and 75% based on consolidated. So there was an extra incentive to really, when you created new improvements, you would drive them to the other businesses as well, because you shared so much, in the success of the consolidated company. Many companies fear that takes too much of the local accountability for driving your business success away by going that far toward teamwork. But again, this is a continuum that we can calibrate based on the specific culture and the objectives of each organization.
Yeah. I'd say it also depends the interdependencies between business units, and those things will determine whether you incentivize at the corporate level or at the business unit level. So it's really individualized for sure. It's funny when you think about that. I do remember one of the experience that stuck in my head was where there was an R&D project that had lasted for close to 8 years, losing money, never getting finalized, accomplished. And then when we implemented this, the executive who was head of that project had quite a bit of influence, and that's why it maintained itself. But once we showed through the strategic resource allocation analysis that we did on its performance versus others and on some of the innovation, they had been trying to squash this for close to 8 years, not 8 years because it was in for 8 years, but after, I guess 5 years, they realized it wasn't going anywhere. After that meeting, it was squashed like within the next day. And that was because that executive saw the facts for what they were and was willing to be a team player and recognize that it wasn't helping the company. It was something that he realized that they just need to set it aside and retool in a different way. So I'd say it definitely rewards collaboration. Great question, though.
Yeah, I think in terms of overall accountability, it really does a great job of encouraging, as you say, people to stop doing bad things. If you're spending money that you shouldn't spend, but it's in your budget, it doesn't affect your pay. But if you're paid to improve RCE, you stop spending that money, you get a share of it. You get people thinking like the money is their own in a very different way, and the behavior is really significant. We've seen people have projects with big lofty forecasts that once they see how they're going to be paid, suddenly they realize their forecast was just an artificial forecast to get approval. It wasn't something they really believed in. And all of a sudden they pull the project and there's $20 million that we can now deploy somewhere else. So it's really, really powerful. We're over time, so I apologize for anybody that stuck with us and really missed something else, what have you. But we're going to end now. But thank you very much for joining. And if you're watching this as a replay, thank you very much. Reach out to us if you have any questions. And of course, reach out if you'd like a copy of that special issue of the Journal of Applied Corporate Finance. We'd love to share it with anybody who's interested. Thank you all.
Thank you.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.